I think what we've said is we think that the pandemic has peaked in developed countries across the world. And what we've done in this second quarter is to include a set of reserves, not only for losses that have been reported to us, but losses which we think actually occurred and will be reported in future weeks and months. That's why the number of $2.5 billion ends up being as large as it is. That's not to say there won't be new losses coming through in Qs 3 and 4, but we're fairly confident that with what we know now, the majority of the losses have already been booked with this large charge we've put in.
I know it makes you a little bit of a hostage to fortune, but what's the best guidance you can give at this point then on the key combined ratio in property and casualty?
So the way we think about this is a normalized ratio, taking out the COVID numbers. We're absolutely on track for what we said in the P&C reinsurance business to be at or below a 97% for the full year. For Corporate Solutions, we gave guidance that says in the context of its restructuring, we expect to be at 105 this year, 98 next year. We've actually been beating that at least in the first half of this year. And there's a reasonable chance, I think, you could expect us to come in better than the 105 for the full year. So that ex-COVID numbers are rock solid. I think COVID continues to have some uncertainty around it, but as I said, I think we're past the worst.
And what are you thinking in terms of the pricing environment? Are we poised to see a better pricing environment now that we've had this big event?
I think that's absolutely the case, and we've seen it in our large commercial risk business, where prices in the first half of the year were up 15% year on year. We expect that to continue. And for our reinsurance business, there's also a strong pricing. One of the important things for the insurance industry, buried in the COVID impacts, is the lower interest rates. So the investment portfolio, not just for Swiss Re, but for the whole industry, is going to struggle to get the returns that it had been able to earn in prior years. That means pricing has to improve, and we see that improvement coming through.
John, you guys in the insurance industry have models for everything, more sophisticated than probably any other industry. I'm curious what you think the unintended consequences of COVID-19 may be. I'm thinking perhaps in the realm of, car accidents with fewer people on the road. Does that mean that we're going to see fewer incidents of car accidents? And how is that going to affect the insurance industry?
Sure. So you're right. We do have our actuaries with their models. I think with respect to COVID-19, the part that was not a surprise was the actual pandemic, whether it's based off of the Spanish flu in 1918, where we actually have very good data in our own models, or the SARS outbreaks. MERS, we've been able to update this, and so the pandemic deaths have not been a surprise. What was a remarkable event and not particularly well anticipated was the global economic lockdown of economies, systematic and for extended period of time. So to your point, there has been a reduction in a series of economic activities and associated events. The obvious place is on driving and a reduced motor set of losses. That does not affect us as Swiss Re very much. It's affected some of the primary companies, and they've responded by either giving rebates back to their clients, discounts for renewals. I think nobody's going to end up making money off this crisis, but I do think we have to look at behaviors. I do think there will also be some fundamental changes going forward from the virus on both the way we work, the way we act, the activities we engage in, and some of those longer-term trends will have an insurance component to it.